All right, hello, ladies and gentlemen. My name is Greg Michalowski. I am the Chief Currency Analyst for FXDD, and this is my webinar for FX Street. First things off, I want to thank the people at FX Street for giving me the opportunity to participate in this webinar. They provide a great service to retail traders around the globe, and I'm honored to be part of the webinar training team, if you will. Before we get started, let me remind everybody that this webinar is intended for educational purposes only. I'm not going to give any buy, sell, or hold recommendations. In fact, we're going to take a look a little bit further back in the month of August into today's webinar. So it's going to be purely on educational purposes, and maybe we'll take a look at the current market as well as we move toward the end of the program here. But as you saw on the slide presentation today, we're going to be talking about the markets where they're not cooperating. They're uncooperating markets. How to approach uncooperating markets. And the answer that I give is pretty blunt. You got to deal with it, folks. You have to deal with it. And so we're going to talk a little bit about that. And what we know is that, in particular, when you look at the most major currency pair out there, the euro versus US dollar, and for those people who are new to foreign exchange trading, I do suggest that you pay attention to this currency pair. This is the most actively traded currency pair. The bid-offer spreads are the most narrow. That makes it easier for you as a trader to make money. In addition to that, the ranges are fairly good. It also trades what I call technically. It follows along from a technical perspective, and we'll get into some charts here today, and I'll show you exactly what I mean. Even in months that are awful. What makes August so awful? Well, this is a daily chart of from August 1st. This is August 1st right here, and this is August 31st right here. And note here in this graph the colors of our candles. You do not have to be a expert to see that the market is very uncooperative. We in candlestick analysis to realize that the market is uncooperative. We have a red candle, that means the market was down. We have a green candle, that means the market was up from the previous day. We have a red candle, the market was down. We have a green candle, the market was up. A red candle, down, green, up, red, down, green, up. That's 8 days in a row, up, down, up, down, up, down, up, down. How the heck are you supposed to make money in that types of markets? Then we have, then we actually put together 1, 2, 3 green candles in a row. How about that? Then we get into green candle, red candle, green candle, red candle, green candle, red candle, green candle, red candle. Another 8 days in a row where the market went up, down, up, down, up, down, up, down, up, down. We put together 2 red days in a row, and they have a green and a couple greens and a green. End up with a red and a red. So the month of August was particularly painful for the euro versus US dollar. If you take a look at the dollar versus Swiss franc, we have a similar type action here with very narrow trading ranges through here, in addition to up down type market. Same type of action, not very cooperative. And some of the other dollar yen had a real sharp move as a result of intervention, but then quieted down in a narrow range. And the pound sterling as well, not too helpful as well. So most of the major currency pairs were in a very a funk, if you will, awful markets in the month of August. What I try to tell traders in these types of markets is that if you can determine, not even necessarily in these types of markets, just in markets in general, if you can determine the type of market we are in, you could use that to your advantage. And what I mean by that is there are basically 2 types of markets. One is a trending market, another market is a non-trending market. So if you understand that the market is trending, that's going to be an advantage to you as a trader. You'll be able to customize you're trading to potentially take advantage of the situations that may exist. For example, in a trending market, you want to be looking to at those corrective moves. You want to be looking for those corrections that come down and test, let's say, a trend line, or test what I like, the 100 bar moving average, or test a 38.2% Fibonacci retracement and bounce off those levels. Those are things that you're looking for in a trending market to get back on that trend to allow you to benefit from those trends markets that tend to be fast, tend to be directional, tend to have ranges that are larger than a non-trending market. Now, conversely, when the market is non-trending like we saw in August, you have to adjust your trading accordingly for that type of market. And some people think that you have to increase your stop loss in those types of trading ranges. I'm not necessarily part of that camp. I think you just have to focus on some key levels out there. Try to get good trade location. If it works, it works. If it doesn't, it doesn't. And we'll get into again the chart, some charts here. So what type of markets were we in August? We were obviously in a market that was non-trending. So what were some of the influences in the market for the euro versus US dollar? And we're focused here today on the euro versus US dollar again because it's most actively traded market, and I think most of you out there probably focus, or you should focus on this currency pair at least as one of your major currency pairs that you do trade. But the same rules apply, or could have applied to other currencies as well. So it's kind of universal. But we're in the summer. We're in the summer, and the market in general, the foreign exchange market in general there's thousands and thousands of traders out there. Don't get me wrong, there's plenty of traders at FXDD. We have tens of thousands of traders, and there are other retail foreign exchange brokers out there, tens of thousands of traders. And then you have the bigger traders, the hedge funds, the insurance companies, the corporations who are doing normal business, Pepsi sending money back to the United States from overseas, so on and so forth. All this stuff goes on. And what we're in, we're in the summer, and this is probably one of the major influences of what happened in the month of August. Let's take ourselves back to June and July as well, and think of what we were dealing with at that time. The U.S. budget situation. We had that debacle that we had to clear up by August, the beginning of August. We're going to increase the debt ceiling or not. That was a major influence. We had Greece and we had Italy budget woes and austerity packages going through. All this stuff took place in June and July. So the beginning of the summer months were anything but normal for a summer. The summer doldrums really didn't come into play until August, and boy, it really came into play in August. But these larger traders that I speak of, they're the ones that really move the market. They're the ones that kick the market to the upside or to the downside. These are the hedge funds. These are the big boys who determine that bid or the market direction to the upside or the downside. Us little guys, our retail traders, we're more followers. We're kind of the leeches on the big guys. We have to follow what the market is saying, and the market is those big guys who move the market back and forth. So they weren't around, or it became pretty obvious that they weren't around. And there were some clues that we got in the beginning of the month that we'll go through here in just a second. We had problems in both the U.S. and Europe, but those problems were kind of toned down in the month of August. There were no major downgrades after the S&P changed the U.S. downgrade on August 5th. Budget issues were over in the United States and mainly in Europe as well. Also, the Fed was on hold, and the EU were on hold. Gold and stocks kind of lost their link as well to the market, and this kind of confused the market. And if you take a look at this is a look at and gold, And what we saw during this period is that when the gold prices, gold prices go up, that's this line right here. When gold prices went up, the euro went up. When gold prices kind of went sideways, the euro kind of went sideways. Then we got into this confusing thing. Gold prices went up, and the euro didn't really know what it wanted to do in the month of August. It kind of just sat there a little bit, kind of going sideways most of the time. It kind of lost a lot of its link in gold, and then we see in September the market moved really out of whack here. The same can be true for stock market. We see a nice link to the upside here when the stock market was going up, the euro was going up, and when the stock market came down, the euro kind of went down. And then we get into the month of, in this area right here, and you see the market's kind of following along with the stock market up and down, and we get into August, and the stock market falls sharply, and the euro kind of goes the opposite way, doesn't it, a little bit, but kind of sideways type market by the same at the same time. So it kind of lost its link. Market kind of got a little bit confused as far as what it should do with these, quote unquote correlated markets that give reasons, at least fundamental reasons, for some traders to trade. But for you as a trader, if you can recognize that it will be a difficult market, what I try to tell traders is that you have to change your focus from the market's non-trending. So you have to, instead of falling in love with the market, you have to fall in like with the market. You have to be flexible. You have to realize that sometimes when the fundamentals seem that the euro should go higher, that it may go higher, but it's likely to also reverse and go back the other way. And when you think the euro should go lower, it may go lower, but it's also likely that it may stop that move to the downside and reverse and go back the other way. So you have to, what I like to say, fall in like with the market and not fall in love with the market. There's a difference. In a trending market, I encourage traders to try to fall in love with the market, try to stay on the trend as long as they can to attack that currency trend. But in a non-trending market, you really have to be more ambidextrous, if you will. You have to bat lefty, you have to bat righty, you have to be, short, and you have to be long. And you have to, but one of the things that you also have to do is be very patient with your trades. Make sure that you wait, and find those good trade locations that are going to make sense. They're going to allow you to define your risk, to limit your risk. And again, you don't want to take on too much risk in these types of markets. You kind of want to pick your spots, and if you're there when the market hits these spots, then take advantage of them and see if it works. It's kind of like throwing a dart sometimes. And I don't want to make it sound so random, but you as a trader have to realize that what you're just trying to do is put the odds of success in your favor. And by trading at key technical levels, using some key technical tools that perhaps the market watches, or you think the market watches, you will be able to, find good trade location along the way, and then make sure that you train your mind to understand that you got to fall in like with the market, not in love with it. That is, if the market starts to reverse itself and goes a little bit too far on that corrective move to the downside or upside after a nice trend move, get out. If there's areas where you think there's going to be resistance, target areas that you think there's going to be resistance, then take a partial profit. Make sure that you're not trading with fear that is going to ruin your trading results. Fear that's going to get you out at the wrong times or stay in a position for too long. And so what I thought we'd do next is take a look at some of these at the month of August. And by the way, the reason why I was doing this report is that the people at FX Street obviously like to have the title so they can post it on the website so they can get people to sign up for and register for the webinar. And so the title was figured out 2 weeks ago or so. And at that point, the market was not. It was in the midst of its non-trading or non-trending range. And so, needless to say, over the last week. In fact, from the point of September 1st, the market in the euro versus U.S. dollar started to trend, but that still does not make this course any less significant, because believe me, folks, we're going to get into this market again, this type of market again, where the market does not trend, where it's uncooperative, where you have to fall in like with the market, not fall in love with the market. Currently, with the euro, the way that it's trading, we're in a different type of market, aren't we? We're in more of a trending market, so this is the type of market that you really want to be in love with over the last week or so in trading. So I'm glad we're back to the trending market than we are in the non-trending market. But nevertheless, there's some opportunities in these non-trending markets, these markets where the market moves up and down, up and down, up and down. So let me take off this PowerPoint, and I'm going to bring up my charts next. Okay, you should see the euro versus U.S. dollar hourly charts here. Can I get a confirmation that looks okay to someone out there? Yes, okay, thank you, Harley. Actually, I want to start off with this daily chart of the euro versus U.S. dollar. And I'll move in a little bit here, take a closer look. This is our month of August. It goes from this dotted line here to this dotted line here. And the tools that I use in my trading include this blue line. This is our 100-bar moving average. It's a 100 simple moving average. And for those people who will look at this 100-bar moving average and say that, well, you're supposed to trade around it when the market moves below it, sell, and the market moves above it, buy. You know, some of you would say that, boy, this tool isn't very handy, is it? The market went above and below at a number of different times here, and I'm sure you know, by following that, you'd be whipped around, you know, a number of different times. Well, that would be true if you were just looking at the daily chart here on the euro versus U.S. dollar. But in my analysis, and what I try to tell traders, is that it's not only about this daily chart, it's about other combining this daily chart with what may be going on in an hourly chart, or what may be going on in a 5-minute chart. Those are the three different charting time frames that I look at. And what traders will ask me as well, or ask me to say, Greg, that so you look at three different charts. So are you looking at the 5-minute chart as a shorter term trading decision tool, and the hourly chart is something intermediate, and a daily chart is a longer term trade opportunity or trades? And I say no. You know, I look at them in total as one. And what I'm trying to do on a daily basis, or when I don't have a position, is to look for those opportunities where there's some confluence between the daily chart, the hourly chart, and the 5-minute chart at certain price levels. And if you can find that confluence, those are the patient levels I speak of. Those are the levels, especially in uncooperating markets where you have to deal with it. Those levels become more important and better clues for you as a trader to allow you to get good trade location, allow you to benefit from trending type moves. So off of this daily chart, although the market was moving above and below, and you know, all clues really, when August 5th came in the euro versus US dollar, and that was the Friday when the S&P came out with its debt downgrade of the U.S. debt. What happened here? And it was a Friday after the close. This is that Friday right here. The market ended up at this point right here. And on Monday, we opened up really high in the euro versus U.S. dollar. The dollar was getting hit. Everyone suspected that the dollar would get hit, interest rates would go flying to the upside, and all this other stuff would happen. Well, what happened? Instead, the dollar opened up at the highs in the first hour, and what did we do the rest of the day? Move sharply to the downside. So at that point, I was saying, I will explain that, Boyke. At that point, I was saying to myself, boy, this market isn't doing what it should do. This market isn't, the dollar isn't doing what all the prognosticators out there said it would do. So it was almost that August 5th was like an aha moment for me where I said, be careful. This month is probably a fall in like with the market, not a fall in love with the type of market. Look for opportunities, but be patient with what you want to do. And if you were to look at, let's say, this move on August 5th and do something like a Fibonacci from the low to the high point right here, you measure the move to the upside. You start to you see the sharp move to the upside. You have this green line, by the way, is our 200 bar moving average. Blue line's always 100, green line's a 200. Fibonacci, I like to use a 38.2% retracement. But on this day, on August 5th, I got a pretty good clue that this area right here was a key area. Why? Because we had the 200-hour moving average right there at the 142.92 level. We had the 38.2% retracement of this move to the upside here at right below that level at the 85 level. So we had 92 and 85 there, and we had what should have been dollar bearish news come out, right? S&P downgrades the U.S. That should be dollar bearish. All right? If I were to ask 100 traders, they would all say, oh, dollar's going to get hit. Instead, the euro goes up, the dollar gets hit, the market comes down, tests the 200 bar moving average, does the right thing here, right? And then starts to move back up to the upside. All right, we had the sharp move to the upside, the correction to the 200 bar moving average, just above the 38.2% retracement, and the move to the upside. Well, we should go higher, right? Well, can we get above the high? No. And the market starts to, what does it do? It starts to lose its momentum rather quickly. And this is where, you look at these days and you start to dissect what's happening here, and you go back and you start to see, okay, what should have happened in this area when the market corrected? We should have gone above, and this is where things called targets come in place. You have the target levels that you have to get through. And so we break to the upside, and where do we get above? We get above this old high. And note here, when the market initially had its first run to the upside here, we stopped at that high right there, and then we came back down to this low. So this level is a key level, isn't it? It's a key level over just a 3-day period, but it's a level that the market can see, that the market can visually define risk at. That's a level that's important. And so when the market bounces up here and gets to this point right here, at this bar right here, I'm going to zoom in a little bit here just to show you. So the market comes down to the 200, comes back up to this level, high here. It broke through here and used it as resistance, high here at this point right here. This, and then we come back down, and then we gather ourselves and we rise and we break above that level. Where's the next target? We're going through this high right here. This market is on its way to take out that high and continue to kill the dollar, to have the dollar go down. Forget about everything that's going on in Greece. This is a dollar selling day. But what happens? The market goes above that level and it stalls. And it stalls quickly. Why? How do I know that? Because the market ended up closing down here, below these levels right here. And all of a sudden, just like that, the market turns its bias and says, this isn't doing what it should do. Let's try the other way. And the big players come in and they say, for whatever reason, they started to sell the euro, and they'll write the story, and they'll probably write the story that, well, it's bad news for Europe and all this other stuff, and they still have problems. And look what happened to bond yields. Bond yields didn't go up; they went down. All these stories came into play, and the market didn't do what it should do. The market, from a fundamental perspective, didn't do what it should do, and so things started to unravel. So clue number one here, and this is where where if you're following the market, following your technicals, you're seeing a failure here, and failures are just as important as of breaks that work. When a market breaks through a level and can't get to the next level and fails and comes back down, it's going to turn that tide and say, we were going bullish, now we're going bearish. And so the next time down through the 200, through the 38.2, what do? We head straight to the downside here. Market sells off. So this is what I mean by following the technical clues, following those levels that are most important on the chart. Now, I want to take it a little further here and do an analysis. We can go through a lot of different days, but I want to focus here, going back to that daily chart, and focus at this 100 bar moving average at 143.50 level. I think that's a key level, and for traders looking at this line here, you're probably skeptical of what the significance of that line is. But I want to go back to this day right here this is on August 15th. So we're now into the month, and the market's going up and down. By the way, off this daily chart here, this is this day is the 5th. So this is the day that we move higher and we come back lower, and we form a low here. We take out the low from the previous day. What should the market do? It should go lower. It does, but then we move back higher, and so it reverses itself and goes back higher from that point. So things are getting choppy. Things are getting really weird. But we were able to put a line in here, trend line that connects a low to a low, and define a lower boundary. And lo and behold, the market does its up and down. This is one of those 8-day up and down regions here, where the market goes up and the market goes down and things. But note here that on the August 11th, what does the market do? It comes down to our trend line, finds support against that trend line, and moves and starts another leg to the upside here. Now I want to focus here on August 15th, and a couple of reasons why I want to do on August 15th. One, on the daily chart, I could see here in hindsight, at least, that we went through the 50% retracement level. The other thing I want to take a look at on August 15th is I want to look at this formation here off the hourly chart, and this gets into the not necessarily confluency here, but what I mean by we'll get into it in just a second here. But what I want to look at is this activity here. What's happening with our 100 and 200 bar moving average? Our 100 and 200 bar moving average over this time period is starting to flatten out, right? That's saying to me, when that happens, that's a signal. Greg, there's a signal here that this market is non-trending. We have volatility. The market's going up and down, but we're not trending. The 100 and 200 bar moving average, 100 hours and 200 hours are just moving sideways. It's not going anywhere here. Not only that, they're converged here. So when the 100 and 200 bar moving average starts to converge, I start to think in terms of, all right, look for a break of a range here. Look for clues in the market that we're going to break, all right? And so you try to look for, key levels, key clues that are going to give you an idea of what may happen. And so when the market starts to move higher here, there's a temptation to buy when it gets above these highs. But and whether or not you did or not, you should have. You should have bought when the market moved above this level, or traders. I couldn't fault a trader for buying above these highs from the previous day, especially when the market held here. But note here, and this may happen or this tends to happen in these types of markets where it's going to be herky-jerky type action. And what happens here is that the market does break below this was a ceiling here and then became a floor at this point right here, and starts to move down. And just like we saw in the Euro chart from earlier in the month on August 5th, we see what is a break, and that should be a break to the next target, to the next key level. And this break comes down to this point right here. It comes down toward where the 100 bar moving average is. Remember here, our two moving averages are moving sideways here, and the market and so we're anticipating a trendish type move away from this area. When the market comes down and tests the 100-bar moving average here, that should say to you, there is something going on here. The market bounced off of that 100-bar moving average. Couldn't quite even get to it. This level came in at 52. The low came in at 62. So we got within 10 pips of that 100-bar moving average, and we see the bounce back up and back above what was this floor here. This floor and ceiling here. We had highs there, and then we found some lows here. And note this bar right here. It finds support against that old support there. And that's the clues that, hey, we couldn't get below the 100. We had the 100 and 200 bar moving average here. We get back above this old floor here, and it's now poised for something to happen. You need a little trader's luck. You need to be able to recognize this, see this, try to put 2 and 2 together. But these are the types of sleuthing and clue searching that you have to do in these types of markets. These markets that are uncooperative, that have potential as well. And so what happens here is the market holds that support against that level, and then we see the market move to the upside here. Let me get rid of this old trend line, this old Fibonacci. It's kind of bother me. So I'm going to put the horizontal line here. Oops, that didn't mean that. Put this line right here. So we had highs here. We broke through here, failed here. We broke through here, or we kind of paused there and moved down, and then we use this level as a support. So you can see why that level, that area is important. The market comes down to 100, moves back up, and starts this move to the upside. I wonder if we put a Fibonacci from here to here. This is another clue that of the support at this level. We have this move to the upside. We have this breakdown to our trend line. We start to move to the upside, put a Fibonacci in there, break through our floor, get to the 38.2% retracement at this point right here, the 100-bar moving average, hold support against that level, and rotate back up to the upside. See the clues there? See what's forming here? It's giving you an idea that there's something going on there in that direction. And so the market starts its move to the upside, and one of the key levels that we have to get through is this 143.51 level. What's the importance of that? Well, remember our daily chart, 143.51 or 50 is where a 100-day moving average is. So we'll put this down even a little pip lower at the 143.50 level. If I can get it, and I can't, but anyway, so you can see that the market has to get through that level, and from there it starts a further move to the upside. So in this example on the 15th, there are definitely clues out there that's going to give you an idea that, hey, there's potential to move to the upside. I can divide my risk. I can limit my risk. I know the 38.2% retracement is right near this corrective level. I know we broke through this low here. I know we should go lower. I know we should get through that 38, and we should get through the 100-bar moving average, but it doesn't. It fails to get through those levels, fails to go through that, and then starts up, and where do we get another clue? We get another clue against the floor here. Market finds support against that floor. Next target get through is the high for the day in the 43.51 level. Get through that level where we have the world is our oyster at that point. We got to look for targets along the way. Now let's take a look at our third chart. So we have the daily chart. We know 143.50, and we also know that the market held this support level down here. On the hourly chart, we did that. Now let's go to the 5-minute chart and see what this chart is telling us on this day on August 15th. And on August 15th, we see the market move up, and we see it come down and test the 100-bar moving average here, and start to find this support against this low right here. We break through the low to the downside. At that time, what are we doing? We're breaking through the 200-bar moving average and also 200-bar moving average on the 5-minute chart at the same time. So again, this is saying this market should go down here, shouldn't it? The market is saying we should go down at this point. We're breaking through the floor area here that we saw on the hourly chart. Now on the 5-minute chart, we're breaking through the 200-bar moving average, and we're also breaking through this this channel right here as well. So this is saying the market should go down, but remember we have cooperating markets here, and what does the market do? It starts to form a base, starts to move higher, moves back above the 200, moves back above the 100, moves above this trend line right here, and it's off to the races. It's off to the races there on the 5-minute chart, and so you're getting confirmation on failures and on the successes here, and the market moves sharply to the upside. You should be long. The market is giving all the reasons to be long. What happens at the 143.50 level? I'm going to take this, move this out a little bit here. Oops, no, I did it. Moved all the way back. That's the problem with getting used to doing what you do. So I've got to wind it back. Remember our 143.51 level? That's our 100-day moving average. Look what the market does. It starts to go up. We get up to that 143.51 level, come back down, come back, test our trend line right here, and break through it. Once we break through the 143.51 level at, let's see, that's 8:45 in the morning, the market sends itself flying to the upside. Trend to the upside. Market trends to the upside. We have a trend line right here, and then you get into, okay, well, how do you exit these trades? How do you look when you're not supposed to fall in love with the market, when you want to fall in like with the market? What do you do to exit the trade? And in this situation, you start to draw your trend lines. You start to draw channels in place. If you can find clues from channels, take advantage of them, because the market's not going to do what it. Remember, the market's going to be uncooperative. It's going to find levels where they want to take profit, where the traders are going to exit the position. So we see the market move sharply to the upside in the next few hours, and then we start a consolidation phase. And on that consolidation phase, really you're getting the clues from the 5-minute chart. Moves sharply to the upside, starts to break below the trend line right here, and then we start a consolidation here. You can actually stay in this position, and quite frankly, I would put like a Fibonacci here as well, and look for potentially, if you want to stay in the position, if it goes below the 38.2% retracement as your exit. But as you can see here, the non-trending really slows this market down, and you're likely to just take your profit at this point and look for a break further to the upside. You can start to draw channels in here on and bull flag channels, and also it allows a 100-bar moving average to catch up with the price at this point right here. Try to move higher at this point, and then start to fail and start to move back to the downside, and that move to the downside is a signal that the trend is over, that the trend to the upside is finished. So the 143.50 level, however, is not over. We saw, going back to that hourly chart here, we see the market non-trending at this point right here, and all technicians will simply put their trend lines in here, find the floor here, see that the market is starting to move down and move back to the downside. But I want to show you what happens in these types of markets when you have key levels like the 100-day moving average here, and the market moves sharply to the upside, started to break lower. And where do we break lower to? Well, look where the market slows down and stops, right there at the 143.51 level. The market finds support on that daily chart the next day after the 15th, right at that bottom right there. Is that a good level to get into the market? It sure is. And what does the market do? It starts its rebound back to the upside, starts to get above that level and forces its way all the way up to where we have a high right here, and then the market quickly fails again on the 16th and starts to move back to the downside. We're about 40. I think about 5 or 10 minutes to go here. What I want to do for the rest of the time period is perhaps look at the current market and take a look at what happened here at the end of the month, where the market started to give clues that perhaps this the upside or this non-trending period was over. And one of the things that we know is that these markets can be seasonal, and just like you have the summer doldrums, you also get into the month of September where things tend to heat up again. Traders after Labor Day and after the bank holiday in the UK are back at their desk. These are the guys that tend and gals who tend to move the market, and so you have to start to look and closely at some of the key levels and focus on what the technicals are telling you. And what we see here in the euro versus US dollar is that we had our 3 defined points along the bottom trend line here. We also started to develop points along a top trend line here. 1, 2, 3, 4, 5 points. And at this point right here, we get a break to the upside. We actually, toward the end of August, get a move to the upside. That should lead to what? Higher prices. What do we get? We get the failure. Why? Because we're still in August. We're still in the last week of August here, and the market still has traders that are on vacation. Traders who are move the market are not there to push this market further to the upside on the break, and the market starts to fail. That failure takes our price back to the 100-bar moving average. The market corrects off of that level. We come back down and test it on the last day of August, the 100-day moving average. How apropos that the market should go down and test and end the month at the 100-day moving average. And then as soon as September rolls around, September 1st rolls around, what does it do? The market opens up a bit above that 100-day moving average and starts its move to the downside. That move to the downside trends with 1, 2, 3, 4, 5, 6 days to the downside. Do we see that type of action in August at all? No. We're in September, folks. Times have changed. Get 1 day to the upside and 2 more big days to the downside. Trade near the lows right now here in the euro versus US dollar. Off of the hourly chart, going back to that end of August period. Here's our last move to the upside, our last gas above that trend line. Let's go back to the daily chart, see where this moves above. This trend line comes in at 145.01. So, excuse me. Let's put our horizontal line 145.01. So here's our move above the trend line. Note here the market on the hourly chart goes up to that 01 level, and then we break above it. We get up to the 46 level, come back down. Market should have really given up here, but we give another shot. Market's still trying to fight itself. But clearly, when you see this type of formation, you start to draw your little trend lines in here. Market on a break of a key level like the 145, that key level off the daily chart, you should see momentum that continues. And what do we get? We get a flag here. We get a formation here that's just not a momentum play. It's saying, I don't want to really go up, but we're above that level, but I really want to go up. When the market breaks back below that 145.01 level here, what does the market do? It breaks below, comes down to our trend line, moves back up to the underside of that trend line, and then starts its move to the downside. Our 100 and 200 bar moving average at this point right here starts to converge. We stay in between those two moving averages here, and then the market breaks through that 200 bar moving average, starts to move lower. Things are starting to look more bearish. We get another little consolidation period here, and the market starts to move lower. When we start to just trend, we start to use our levels and just follow the market down. We get the Swiss National Bank come in, force the euro to the upside here on the corrective move to the upside. What do? We get above the 100-hour moving average. Market moves up to our old ceiling right here at this point right here, and the market says, nope, we want to go back down. We break back below that 100-bar moving average. The next bar tests the 100-hour moving average, and the market sells off to our trend line right here, finds support against the trend line, and then break above. And where do we go? Go to the 100-hour moving average. These are the normal markets that we love in trending markets. Come up to our trend lines, our moving average lines, hold that level, start to move down again, hold it, move down, trend down in our channel here. Breaking below the channel, trying to, and this is a significant channel here This has 1, 2, 3, 4 different points here, and the market is currently trying to break below the one, or is below 137.28 level. Folks, I would watch that level here in today's trading. If the market is able to get back above that 27 level, this will be a failure on the downside, and the market has potential to move higher. If we can't get above that level, and right now the bias is still to the downside, here breaking below this, we should see an acceleration of the trend to the downside, but this is already an acceleration of this trend to the downside here. So you have to be a little bit cautious here in your trading, but the bias is to the downside. Your stop should be above the 27.28 level. That's at least how I see it right now, and then we should see a little rebound. Where would we go? We're heading up toward this. We would head up to the next stop would be 137.88 on the top side. So that about does it here for my program here today. If you have any questions or comments, feel free to put them in. I know, again, it was a little bit kind of go back in time, but what I hope to have accomplished here today is being able to, or trying to understand what types of markets we're in. And if we're in a non-trending market, remember the phrase, fall in like with the market, don't fall in love with the market. How do you know a market is non-trending? Take a look at your moving averages and see the reaction of what the market is doing to key fundamental news. If the market isn't doing what you think it should do, like it did on August 5th, when the dollar should have gotten sold, in my mind, and probably a lot of other people's minds, when interest rates didn't go up like they were supposed to, all these things kind of contribute to this idea that this market isn't cooperating the way it should. So take that as a clue and try to adjust your trading strategy accordingly. Also clues from the technicals, again, 100 and 200 bar moving average starting to move sideways. That's a clue that the market is non-trending. Understand that there still are opportunities within these types of markets if you can find levels that are going to support a buy or sell decision. Look for 38.2% retracements holding. Look for moves away from converging moving averages. Look for the 100-bar moving average, perhaps the holding of the 200-bar moving average at the same levels. It's 38.2% retracement. Look for these clues that are going to give you confidence in your trade and also allow you to define your risk. You're not guaranteed that the market's going to do what you think it should do. All you're guaranteed is that by defining a risk against key levels, you'll be able to limit your risk to a manageable amount so that you don't blow up in these types of markets. You don't get caught being too married to a position. You're listening to what the market is saying. So those are the things that I look at. So what are supports for this month in the euro versus US dollar is a question that has come in. And what I'll look at here, where we're going, what are the targets here, and what I'll look at here on the is the daily chart for the euro versus US dollar. And what we saw here from beginning of January, this is the low for the year, this is the high for the year. And then we had these months of, this is okay. This was a nice trend to the downside. This is a nice trend to the upside. This is a nice trend to the downside. And then we started to get into, and this is an okay trend to the downside, and this is an okay trend to the upside. I don't mind these types of trends, because if you start to look back at your hourly and 5-minute chart, you're going to see these with the clues. And also note here how the market kind of held this 100-bar moving average. And again, if I were to zoom in here, take a look at it, we held it to a T right here when the market initially came. And these times when the market tried to move below, we failed. The market moved up each of those times. When we broke below it, what do? We come up to the 100, and then we move above it, and then we move below, and then we get into August, and things start to get a little hairy here, but it really not, because we saw how the market moves around that 50 level. So anyway, getting back to your question, where are we going in the euro versus US dollar? So I have a Fibonacci from here to here. We've broken below the 100. We've broken below this trend line. We've broken below the 200. We also fell below this trend line right here. Look how far this trend line goes back, June of 2010. So from a technical perspective, what are you saying? Well, we had all these clues to go down here on the daily chart. And what's our next target? Our next target is 61.8%. 136.62 is that level. Our low for the day came in at 136.97. So we're within 35 pips off the daily chart of getting to our next key support level for the euro versus US dollar. Is that enough for people who have been short this market, who have found, who sold it up at these areas to take profit down here? Within 30 pips of that, we'll see. Now you have to go to our hourly chart, and what we saw here on the hourly chart, is that we fell below this key 28 level here at which is a parallel trend line off of this move to the downside, and also a trend line off of these points right here. So this is a key level here, and the market's currently trading right at 24.25. So we have to get above that 28 level here for today's trading to keep this bullish bearish bias intact. I'm going to put a horizontal line in at the 28 level. I guess we just went above it, but now we're failing back down below, and the market's selling off here. So kind of got a quick move to the upside and a quick move back to the downside. It's going to continue to remain a key level here for the euro versus US dollar. I'm going to put my Fibonacci's in there. But the next key target on the downside, folks, is 61.8, 136.62 is where that level comes in. Quick view of gold. From what I understand, they raised the gold margin requirements again here. And not seeing much reaction in gold. This move to the downside, margin requirements kind of led the way to the downside here for gold. Off the daily chart, failed above here, and probably I don't know what caused this sharp decline 2 days ago. Except other than a failure on the top side of gold, a failure to extend above that. Again, it was one of those things where gold should go higher, shouldn't it? What else is there to invest in but gold? But what we saw, the market failed on the top side. What did? We came down to our 100-bar moving average, broke through the 100-bar moving average. So from a technical perspective, the market did what it should do, oops, just spilled coffee. No, not on my keyboard. I'll deal with that later. Let's put a Fibonacci from our low to our high. Broke through the 50% retracement here, and next target 61.8, and then found support again at the 50%. Moved up to our 100-bar moving average, moved below it. Moved above it here today. Gold margin requirements raised, caused the market to move sharply to the downside. Now we're seeing a rebound to the upside. What I'm seeing here is a market that's fighting between some fundamental or some attempts to slow the rise in gold prices, raising margin requirements makes it more expensive for speculators to enter into the market. You have to put up more margin, and you have to put up more margin. That means you need more margin. You can't use as much leverage as you did before. We all know about that in the foreign exchange market. So we're seeing that effect here to the downside, but we're seeing a rebound as well on. Let's see, what's the stock market doing? Down 173. So there's that desire to be in the safe haven gold, and so we're seeing that rebound back to the upside. We're seeing a confused market here. Watch the 100-bar moving average and the 200-bar moving average on the hourly chart. It's kind of a fall in light. Oh, look at this on the 5-minute chart. We're right at the 100 and 200-bar moving average here too. So we have a few reasons to think that there's good resistance up here at the 1863 level here. If we break above that level, it should go higher. It's going the same way. Boinky's dollar yen CFTC shows yen longs can hit a record low and crawl back to 80-85 level this year. We're seeing that there are people who are long. So yen longs, yen long or dollar? Yeah. So yen longs. Typically, when yeah. So what the point is what MRC is saying here is that there's a CFTC data that comes out and once a week, and what that data shows is the net long and net short positions in currencies, currency pairs against the dollar. So what MRC is saying is that there are yen longs. So if there are yen longs, then there are dollar yen shorts in the market. So because if you're long yen, you're short the dollar. So, and typically what happens is that it goes the other way. The market goes in the opposite direction. If you bring up like the CFTC thing, what typically people will do if the market gets over now, I don't know the relative long of the yen, but if there's a lot of longs in the yen, that means that the market is really short the dollar yen, and oftentimes it squeezes to the other side. So, but I don't necessarily use that in my analysis. What I see in this chart is that right now we're getting above this high. This high came in at the 77.68. We're currently trading at 80 right here. We're also looking to approach this high at 84. Non-trending, non-cooperating market in this area right here. This has given me some clues that there's potential to the upside. Let's take a look at the hourly chart. And what we see here on the hourly chart is we see the 100 and 200 bar moving average moving sideways here. Not surprising, being non-trending. Market moves above that level, comes back down, and gets pretty close to the 100 bar moving average. This level comes in at 0.08, and our low came in at 13. So that's 5 pips. It looks like it's a lot more than 5 pips, but it's only 5 pips at that point. So the market found some support against that level. This floor here was also there at that point, and we rotated back up to the upside. Now I've put in a channel here off of these lows right here, and put a parallel channel just off the high here. And note here, we went up to that high here in respect to this, and I put this channel in here today to kind of guide me in today. The other thing that we're above here is this 71 level right here, and you can see the market went up to the top end of this channel, came down a little bit below that level, went down to the 69 right here, and then moved back higher. So we're kind of in between resistance and support right here, and it'll depend on whether we break below the 71. We could head on down there, move there. What is there fundamentally to say that the dollar yen should go to 74 or 80 or a level like that? What was stopping it before from going lower? In the face of their economic situation in Europe, nothing really. So I then rely on the charts kind of to tell me what the tune is and what the direction should be. Is this a great level to buy up here? No. Is it a level to buy against the 71 level? Yeah. Is it a better level to buy against this trend line? Yeah. Or these highs right here. Yeah, I would be more. I would probably be a buyer, and I would be a buyer. Well, this is only at what, 57, somewhere around in the 57s to 60 area, and just put a little stop down here and see if this market can extend to the upside. That's how I see it, anyway. I'm not sure about the 80 level though, or is there a possibility to get up to 80? Yeah, I mean, from a longer term perspective, here's where a key target is here in the dollar versus yen. Let's go. I'm not getting any, close it up from Maud, so continue on. If you have more questions, I'm happy to do them. let's look at the dollar versus Swiss. This 100-day moving average, we hadn't been above the 100-day moving average. We went above 3 or 4 days here, no days here, all the way back to June of 2010. And, you know, the 100-day moving average is way up here at the 109 level right here, and we broke through it last week at the 83 level. Now let's go to the dollar yen. Not that they're going to do the same thing, but look at how the market held the 100-day moving average. Held it here, held it here, held it here, held it here. Started to move down. We created this trend line. The market held that trend line at that point right there. You know, nice technical levels. So if this market is going to go up, all right, where and we're in this non-trending, so this has, you know, pretty good potential to move to the upside. Let me just say, there's room to roam here, okay? There's room to correct. Where do we correct to? Well, let's take, this is the trend, right? Trend down, non-trend, test the 100, test, you know, form a trend line, move to the downside, intervention, test the trend line, move down, stay along the bottom trend line. You see how it's, you know, it's moving, it's trading technically, folks. This break, you know, has to be a technical move to the upside here. This was a low here, a low here, low here, low here. Break below that level, move above it, break below it here, test it, move above it, right? So all these should say the market has a potential move to the upside. So what's our next target? The next target is 78.50. Then we have this trend line at 78.69, and this 100-day moving average again at 79.43, 38.2 at 79.59. Those are the progressions targets along the way. That's where we're going. As long as the price can remain above this trend line, things are looking better there for the dollar versus yen. I heard something come in. Is that it for me, Maud? I didn't see any comment here. But anyway, I don't see any other questions. I want to thank everybody, and I got to go anyway. I got work to do. Thank you, everybody, for coming in here today to our webinar. Nice crowd. Again, thank you to the people at FX Street for providing the service to me and you. And hopefully you learned something a little bit about the markets and about different types of markets, how to trade them. Safe weekend. Talk again next week at FXDD, and I'll be back at FX Street later on in the month. So look for me then. Thanks a lot, everybody, and thanks again, Ward and Vicky. Bye-bye now.